Feeling lost on whether a stock's actually cheap or crazy expensive? Don't worry. In under 5 minutes, I'll show you the simplest way to estimate a stock's return using just Morningstar and a calculator. Let's jump in. Our first step is to find the forward earnings yield. Basically, the return you'd get if next year's expected profits turn out as projected. Go to Morningstar.com and type in any stock. Let's start with Target. Click on the Valuation tab. Scroll to the right and find the current column. Then find the forward price to earnings ratio. This tells you what investors are paying for next year's profits. To turn that into a yield, just flip it. 1 divided by the forward price to earnings ratio gives you the forward earnings yield. Target's forward price to earnings ratio is 11.41, which gives a forward earnings yield of about 8.8%. Think of it like buying the whole company. You'd earn roughly 8.8% on your investment if next year's profits are accurate. To see the full picture, though, we also need to account for how profits are likely to grow or shrink over time. So we look at revenue growth and net income growth. Click on the Key Metrics tab to find this information. Target's revenue was rising for years, but lately it's flatlined. Net income, the actual profits, bounce around, but overall, it's been slightly declining. The numbers tend to hover around $4 billion, trending down. So a fair guess might be negative 1% annual profit growth going forward. It's not exact, but that's the art of valuation, making a reasonable assumption. You can also find net income growth percentages on the growth tab of this section. That will help you make your assumption. Now we just combine our forward earnings yield with our growth assumption. 8.8% earnings yield plus negative 1% growth equals roughly a 7.8% expected annual return. That's what you might earn per year if you held Target stock long term, assuming no major surprises. If that number feels low for the risk, it might mean the stock's a little overvalued right now. Let's test this on a more exciting stock, Palantir. Palantir's forward PE is around 189. Flip that and you get an earnings yield of just 0.5%. That means investors are paying a very high price for profits that may come years in the future. So the entire bet here is growth. Palantir's revenue has been climbing fast and profits are meaningful, but future growth is hard to predict. Because the company is still developing new AI products and securing new government contracts, we don't have a clear history of earnings growth to rely on. So now it's up to you. What do you think Palantir's average profit growth will be over the next decade? 10% per year? 20% per year? 30%? Let me know in the comments. That's why valuing fast growth companies is hard. They can look insanely expensive today, but if they grow into those earnings, they can still outperform. Of course, we need to also account for potential downside. Here's a simple rule of thumb. Stocks with a low PE and stable growth tend to offer safer, more predictable returns, though you might have to accept a lower return. Stocks with a high PE and uncertain growth can offer a bigger upside, but the downside is also greater. In other words, the safer the stock, the more predictable your return. The riskier it is, the bigger the swings, both ways. So here's your simple valuation formula. Earnings yield plus growth equals expected return. Once you start thinking this way, every stock quote starts to make more sense. You'll know exactly what you're paying for. Yield now, growth later. Want to see if a stock is truly cheap or expensive compared to the market? Hit like and I'll show how your valuation stacks up against the S&P 500. Once you understand that, you'll see why the market's record high PE might actually make sense when growth expectations are higher. If this was helpful and you want to learn more, join me on Discord. Link in the description. I'd love to help you. And drop a comment with a stock you'd like me to value next. Thanks. Bye.